The following podcast was recorded on Wednesday, February 2nd, 2022, featuring Jim Bianco of Bianco Research and Sam Rines of Arbor Data Science. To hear the podcast in real time, you can sign up for a free trial at biancoresearch.com or arborresearch.com, or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of our podcast series, Talking Data. I'm your host, Kristen Radosh of Arbor Research and Trading. I'm joined today by our presenters, Jim Bianco of Bianco Research and Sam Rines of Arbor Data Science. Today, Jim and Sam will be giving us their outlook for commodities. Jim, we're going to get started with you. What are commodities and does an index make sense?
Yeah, that's a good question because everybody thinks of commodities and they like to talk about, what do you think about commodities? And I'm fond of saying crude oil, copper, cocoa, coffee, and corn all start with the letter C, but they could not possibly be more different from each other than you could imagine. And I'm not so sure they all belong in an index together because they're all different. They all have different fundamentals. They're all different uses. There's really not a whole lot in common with them, except you could drop all of them on your toe. So if you go to the next chart, this is the other problem you have with a commodity index. This breaks down the Goldman Sachs commodity index. And this index is admittedly heavily weighted. It's towards energy. About 40+% of it is energy. But a commodity index you could break down into three parts. The spot return, which is what everybody thinks it is. The roll return, which is really what it is. And then interest, because you're buying commodity futures and you invest them in T-bills, and that's not been a lot. So the second panel on this chart shows you the year-over-year change in the spot return and the roll return, year-over-year change in the spot return and the total return, which appears to be different. But then if you look at the bottom panel, you'll see that that roll return is very volatile. And how does that imply? Go to the next chart. The next chart is a chart of the Bloomberg Spot Index. This is simply an index of whatever the price is of whatever we're talking about, copper or corn or crude oil. Just index all its prices together, and it's at a new high because everybody knows that the spot prices are up. But you don't buy spot, you buy a futures contract, and then you have to roll it to the next futures contract and roll it to the next contract. So when you look at this chart, you'll see all-time highs. Go to the next chart, which is the Bloomberg Commodity Index. That now puts the roll index in there, and all of a sudden, it's nowhere near its all-time highs. So if you want to invest in commodities, you should spend the majority of your time looking at the roll, the difference between the front month and the second month, calculating the contangos, the backwardizations, the interest costs, and then when you've got some time between lunch, think about whether or not crude oil prices should be going up or down, or copper prices should be going up or down, because it's really not that important when you invest in a commodity index. But yet that's what everybody spends all their time looking at instead of looking at roll returns. And that's why, and then you're throwing in on top of it a bunch of unrelated things that happen to start with the letter C. And I'm not so sure that there's really such a thing as commodities. That's why for the rest of this podcast, I think what we should be doing, which is the correct way to do it, is talking about individual sectors of commodities. What do we think about various things like energy?
And Sam, we'll get started with you next. Can you tell us about energy?
Sure. So if you flip to the fourth chart that we have here, one of the things that you can see is that oil on a spot basis is sitting at about $90 right now. Which is a pretty good price. It's bounced back very nicely over the past year. Demand is going strong. People are driving more. People are beginning to get back on planes, at least in the US. And so the demand for oil has begun to creep up. What's interesting about this bounce, though, is if you look over history, you would have expected more rigs to come online, right? You would have expected rigs to begin to come back up and come back in a pretty strong way as the oil price moves higher, to take advantage of it for both large and small and mid type companies, particularly in the Permian and shale. right? Your $90 is well above your typical break-even price for some of the better shale regions. The issue now that we're seeing is a significant breakdown in the supply chain, right? It is very difficult to drill a new well because you can't find the pipe that you need. You can't find the labor for the concrete crews. Fracking crews are strained and very thin right now. So you're having these supply chain issues, not just on the delivery of oil from point A to point B globally, but really at the wellhead as well. It's pretty difficult to see the U.S. being able to really pick up its oil production in a meaningful way without having many more rigs come online. One of the more interesting surveys out recently was the Dallas Fed does an energy and manufacturing survey. And one of the pieces of info that they said was, listen, we're not getting back to 2019 type production numbers in the United States anytime soon. That's a pretty stunning thing to think about when oil prices haven't been this good since 2012, 2013. So I would say that this is a much stickier problem within the energy complex than is commonly given credit for.
Sam, how about internationally? What are you seeing in terms of production internationally? I mean, everybody turns their eyes to OPEC and they think the Saudis can magically fix this problem. What say you?
That's interesting. You have the OPEC Plus meeting later this week. It doesn't look like they can really turn that much on very quickly, right? They're barely meeting their current quotas, never mind cheating them, right? You would typically see them cheating at $90 Brent, but you're not seeing much cheating at all. That's a sign that it's going to be difficult for them to turn on that incremental barrel. Another thing that we haven't seen is China actually turning up its oil production. It's commonly overlooked that China is the #5 oil producer in the world on a domestic basis. They have quite the reserves of oil there, but they haven't turned on much. Even at these prices. So it's very difficult for me to see OPEC Plus really being able to bring on that incremental supply in a meaningful way. You could see some better output from Libya, or maybe if we have a deal with Iran or something like that, there could be incremental barrels of oil put on the market from some of those more depressed regions. But it's not going to be Saudi Arabia and Iraq that are really turning it on.
How about ESG? How is that impacting everything right now? Or when we talk ESG, my criticism of it is it's all E and little s and little g.
Yeah, so look at Exxon, look at Chevron, right? Their profits are doing very well, and normally you would see a significant amount of CapEx and longer term projects beginning to come online, or be guided at least. And what you're seeing now is a significant return of capital to shareholders, right? They're not expanding their production much at all. So it's interesting. I would say that ESG has in a lot of ways taken away some of the incremental investment that we need, right? We're not oil free by any stretch, that we need to meet even slowly declining global demand for oil over the next 30 years if somehow we can replace the grid needs with nuclear and solar and wind. You're still going to need oil, right? We all like plastics, and Tesla is built from plastic. So it's going to be a really interesting world if we don't begin to at least understand what kind of investment we need to make in the ground in order to not have rolling energy crises like we've seen in China, like we saw in Texas last year, et cetera.
And Jim, can you talk next about industrial metals?
Yeah, so energy is obviously one big area that it impacts the global economy. The other one is in industrial metals as well too. And what's been going on there? If we take a look at the first industrial metal chart, this is the CRB Raw Industrial Spot Index. Now, I'm a particular fan of this index because there has been accusations that the commodity markets are overrun by speculators. We go through what Sam just said, and then all of a sudden somebody says that, WTI, February WTI broke the charts, and then a bunch of money comes in and it goes up or it goes down, and it completely overruns those stories. So what I've done here by looking at the Raw Industrial Spot Index is it has a bunch of commodities that either don't have futures contracts or are not dominated by futures contracts. So the components are hides, tallow, copper scrap, lead scrap, steel scrap, zinc, tin, burlap, cotton, print cloth, wool, rosin, and rubber. And extra credit for anybody who knows what tallow is as well. And so what that shows you is if you look at these industrial use types of commodities, it's pushing a new all-time high too, taking out its April of 2011 high. So you see very, very strong demand for very high prices for industrial commodities. If you go to the next chart, which is the most common industrial commodity everybody looks at, is copper. Okay, when you talk industrial they think about copper. Well, the price of copper is more than doubled off of the March 2020 low, and so it is really taken off quite a bit. And now the question becomes, what seems to be driving these industrial commodities higher? Well, one thing industrial commodities benefit from is that they're produced in more stable places than energy, because the problem with energy is that most of it comes from the Middle East, or enough of it comes from the Middle East, and we always worry that there's going to be a war or some terrorist attack or something that's going to upset the apple cart there. And so there's a lot of political risk in energy. There is political risk in industrials, but not as much. So if you go to the next chart, what this chart shows in green is the Bloomberg Industrial Commodity Index, which is heavily dominated by copper, and it has gone up by almost 100% since the March lows. And overlaid on this chart is the Citibank China Data Change Index. Now, what that is this is a diffusion index of all of the statistics that come out of China looking at its economic growth. That chart peaked last summer, the red line, and it's been going down. China has been slowing. And this has been the universal call in industrial commodities for months. China is slowing, sell copper. China is slowing, sell industrial metals. The problem is China's slowed and industrial metals have gone up another 30 or 40%. And they continue to slow, and we continue to make this statement. I think what we're missing here is what Sam hinted at with energy, the breakdown of the supply chain. Yeah, it sounds good that if China is slowing, that should sap in demand for industrial commodities if you assume a normal flowing frictionless supply chain, a circa 2019 supply chain. We don't have anything close to that right now. We have a very friction-filled, sputtering supply chain. So what you're seeing is, even though China is slowing, and that suggests that their domestic demand for industrial commodities is waning, the demand for industrial commodities from the West is not. That has to go to China to be turned into finished products to be shipped back to us, and the supply chain is struggling to try and keep up with it. So I think what you're going to see with industrial commodities is a continued move towards higher prices. And largely it is somewhat of a supply chain issue. It's also a world demand issue. And the idea that China is slowing, so they should be sold, like I said, they got to fall 30% from the time that everybody started that idea. It hasn't been working because of other things like the supply chain and let's say developed country demand has taken center stage over what China's doing.
And to further Jim's point, and I think this is a really interesting one, China hasn't really reopened at all, right? They have they have the Olympics coming up for a month alongside a shutdown for the lunar holiday. And then you have the real possibility of China beginning to stimulate their economy, really go back to an infrastructure-ish heavy type investment move. And that comes in Q2, and that comes at already high industrial metal prices. So that's something to watch out for too. That's the other catalyst that I think this chart correctly points out in a way, is that China has been slowing, and China doesn't really like to slow down a whole lot for very long. So once they begin to really put the pedal down, it's worth watching industrial metals, because you already have, call it the worst news in there from China.
And finally, today we want to cover off on everything else within commodities that we haven't touched on yet.
I guess I'll start and I'll just make a quick comment about the grains. Beans in the teens, you got $15 soybean. They're really taking off right now, but you're not quite seeing the move in corn or in wheat as much too. So you've got a bit of a mixed bag when it comes to the grain complex, but you've got soybeans going higher. Soybeans are the highest protein of all of the grains, and that should probably continue to push up the UN World Food Index, which is going to make a lot of policymakers unhappy.
And I'll just touch on wheat quickly. It's interesting that wheat really hasn't moved much, particularly given what's going on in the Ukraine. Luckily, right now, the Ukraine is not a significant contributor to the global wheat market. That changes in the summer. So if we don't have a resolution coming soon, that's another tailwind for wheat in particular.
If I turn to precious metals real quick, the word I've used with gold and silver has been frustration, because in theory, if you look at the story that we've got inflation, we've got uncertainty, we've got war drums, we've got the Fed tightening as well too. We've got volatility in financial markets. This is what Peter Schiff lives for, this exact moment. And yet gold and silver aren't doing a whole lot of anything right now. And that's why I said it's frustrating. If you look at the news, it should be the perfect storm for them. Now, technically they're consolidating, so maybe they break out and they start moving higher, but they haven't yet. Right now, there's an argument to be made that the marginal demand for gold or silver is being sucked into the crypto market for the same reason. There might be some validity to that idea, but nevertheless, I think the problem with in precious metals is they got everything working for them, and they're just not seeing it show up in their price. And the longer this goes, that the price doesn't respond, the more you have to wonder if the window is closing on some kind of a rally. I still remain hopeful that you'll see a breakout in crude, I was going to say crude oil. Hopefully you'll see a breakout in gold and silver, but I'm saying hopeful. A couple of months ago, I would have said bullish, because I'm getting, like I said, that word frustrated that it isn't going yet.
Well, thank you, Jim and Sam, for your thoughts today. Thank you, everyone, for joining us. As a reminder, Arbor Research and Trading is an institutional research and brokerage firm. Our two most prominent offerings are Bianco Research and Arbor Data Science. For any questions, please contact Gus Handler at gus.handler@arborresearch.com. Have a great day.